program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View here at AusBiz as we get underway for this week. I'm Andrew Gagan. Thanks for joining us. Let's first take a look then at what happened on Friday. Global shares gaining on, a highly anticipated Fed Reserve interest rate cut decision this week. The latest read on US inflation coming in line with forecasts, boosting expectations that the Fed will make another cut, and that saw the US dollar weaken further while stocks rose on Wall Street. Now, for the week, all three major indices advancing, the S&P up 0.3%, the Nasdaq rising almost 1%, and the Dow rose 0.5% on the week. Stocks specifically on Friday, shares of Warner Brothers Discovery climbed after Netflix agreed to buy its TV, film studios and streaming division for $72 billion, ending a weeks-long bidding war. Netflix shares closing lower, while Paramount Skydance, one of the other bidders from Warner Brothers, tumbled almost 10%. Shares of Southwest Airlines, it climbed despite lowering its FY25 EBIT forecast, citing lower revenue due to US government shutdown and higher fuel prices. Ulta Beauty shares surged after the beauty retailer raised its annual sales and profit forecasts. And shares of lingerie maker Victoria's Secret also surging as it raised annual sales and profit forecasts, betting on strong demand. And expectations of a Fed rate cut saw the gold miners rise, well, mostly aside from Newmont there, but also the energy companies higher, led by Halliburton. Well, US consumer spending increased 0.3% in September, adding to 3 straight months of gains, while a lackluster labour market and rising cost of living curbed demand. Annual inflation rose at its fastest pace in nearly 1.5 years in September, with the Personal Consumption Expenditures Price Index increasing 0.3%. And consumer confidence rose further, with 5 to 10-year inflation expectations falling to 3.2%. Now, in response to the latest economic data, US National Economic Council Director and Fed Chair candidate Kevin Hassett said it's a good time for the Fed to cautiously reduce rates, and that's what he expects the central bank to do this week. And commenting on forecasts of economic growth of 3% in the first and second quarters of 2026, he said, "I would be disappointed with 3. It could easily be 1% higher." Well, US Treasuries weakened on Friday, lifting yields to multi-week highs as investors brace for signals of a shallower easing cycle than expected. The US 2-year Treasury yield there rising to 3.56%, a 10-year was at 4.14. Markets are pricing in an 85% chance that the Fed funds rate will be cut by 25 basis points at this week's meeting, with a total of 3 more cuts in the easing cycle. The US dollar slipped on Friday. The Aussie is trading at 66.3 US cents. And in terms of commodities, oil prices rose to a 2-week high on Friday on expectations of the rate cut that would boost economic growth and energy demand. Brent futures up around 1% at $63 a barrel. Copper was up 1.7%. Iron ore falling 0.5% to 106 US a tonne. And gold falling back below 4,200 US an ounce. And Bitcoin, it's currently trading at around 90,000 US dollars. Well, let's now catch up with Matthew Goodson. He's the Managing Director and Portfolio Manager at Salt Funds in Auckland. Matthew, welcome back. Good to catch up with you. How have you opened there in New Zealand?
The usual quiet Monday morning open, and right now we're just up about 20 or so points for the market. But that will no doubt change as the afternoon progresses.
Indeed. In fact, what are you expecting for the week, of course, as we rapidly head towards Christmas?
Yeah, well, there's 2 last big rate decisions, really. The RBA tomorrow, where we'd be very surprised if anything but a hold, and the Fed on deck 10 their time, which I think the market's now priced in a 90% or so chance of a 25-point cut. So if they don't get a cut, it could be could be rather volatile. So that's really, I think, the key one that hasn't necessarily been fully priced.
What's your view on global equities at the moment and how they're poised?
Look, what we're seeing in a lot of markets is that large cap equities are tending to be very expensive, but there's a lot of interesting opportunities available in smaller to mid cap names. And there's also been huge sectoral dispersion, led out of the US, obviously, with Magnificent Seven, but that's also been a factor around the world. So, look, there's actually quite good volatility and valuation dispersion for active investors at the moment.
Now, in your part of the world, speaking of central banks, so you had another cut more recently. Is that the end of the cycle? Is that the perception at the moment?
Yeah, look, we've gone to two and a quarter. I think the terminal, the path now has it at 2.2, suggesting a fractional chance of something more. I think that would be a real surprise. The key question is what happens in 2026. I'm hopeful that we might not even see a move through 26. Our inflation pressures in New Zealand are not that widespread. Local authority rates are the biggest one, and the government's moving to try to put a cap on those. And other things that have been persistent, such as rents and private insurance costs, have now well and truly peaked, and zero or even negative in the case of rents, which is very unusual. So we're actually hopeful that you could have a year in 2026 of benign inactivity from the central bank.
So at the moment, Matthew, as you're seeing it, partial indicators there perhaps pointing to the Kiwi economy having turned the corner then. You feel as though you've passed the bottom.
Absolutely. Yeah, the June quarter was a very tough winter here. But since then, we've seen a good retail sales number, which you could also see actually when you picked into centre groups, sales by centre across Australia and New Zealand. You could see that the New Zealand sales actually started to pick up in the September quarter, and that will have continued. We've seen some reasonable building consent numbers. And every month, ANZ banks run a business outlook survey for many years, and firms' own activity outlook over the next year was at its strongest level in over a decade. So it has cried wolf a couple of times, that measure, but this time it may well be for real. So there's enough happening here which suggests 2026 could be a pretty good year for the Kiwi economy.
Now, in fact, you've got a new governor of the Reserve Bank there, Anna Bremen, the Swedish central banker. So what I gather, she started at the beginning of the month. Have we heard from her? What's the anticipation of perhaps the direction she's going to take the central bank?
To be discovered, she's given a little bit of testimony before the Finance and Expenditure Committee, basically telling them it's your job to ask me hard questions, which is a nice change from Adrian Orr. But those who have passed her record suggest she possibly leans slightly dovish. But I think, look, it's going to be hard to tell until we gauge the central bank's reaction to the evidence that unfolds next year.
All right. So, Matthew, on the corporate front, what's making news at the moment?
Well, we've just been through our November results season. Being a March tax year here, we have a number of companies have their half-year results in November. And for the first time in a while, it was actually an okay season without significant downgrades following out of it. And several names actually did very well. For example, Sanford, the major fishing company, which hasn't added a lot of value over many years, had a good, strong result. And also the likes of Mainfreight, their New Zealand and Australian business, outweighed some pretty tough times in the US. And Tower and Turners, which are, while not all the stars have aligned for them, also delivered extremely strong results. So, it was a solid result season. To date, our markets, I think, moved largely in anticipation of a better future. So, the February results season is really going to be crucial, I think.
And I gather the listed property sector has been particularly weak. Are you seeing turnaround there?
Yeah, look, it's still up about 15% for the year. But what's happened is a couple of the larger companies, Precinct Property and Vital Healthcare Property, engaged in a couple of large equity raisings, all up taking just under half $500 million out of what is a fairly small listed property sector. So There's just a little bit of short-term indigestion, which saw the sector be quite weak last month. But looking forward, it should be a decent year for listed property next year. There's a huge gap to current term deposit rates, and certainly starting to get feedback from a couple of them that tenancy inquiry in industrial and even in office, which had been weak, is starting to pick up quite nicely. So they could be in a sweet spot next year where they get improving occupancy, improving rents, but rates stay unchanged.
Matthew, enjoy your week. Thanks for joining some Salt Funds.
All right, thanks very much. See you.
All right, let's turn our attention to the local market then. Just ahead of the open, we are expecting a negative start there. SPI futures down 0.25%. So we're going to get across the latest corporate news. But of course, the big event this week for us is that RBA decision tomorrow. Expectations, they will be leaving rates on hold, but concern about next year, perhaps the next move could well be up. We'll find out that commentary from the RBA tomorrow. Meanwhile, stay with us. The open, just a couple of minutes away.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.